Today, we're talking iron condors, what they are, how you can trade them, how you enter them on Robinhood. I suggest that you have a background in credit spreads. If you don't have a knowledge of what those are, you can watch my tutorial in the upper right-hand corner. If you don't want to do that, that's fine. I do a refresher on them. It's just gonna make things easier if you know what credit spreads are. So without further ado, grab some paper, grab a pen, grab your jewel. Let's dive into this. All right, let's build this puppy from the ground up, all right? If you have a conceptual understanding of what iron condors are, you're gonna be able to intuitively manipulate them on the fly, which makes you just a better trader overall. You can understand what happens when you change strike prices, expiration dates, all that good stuff. Okay, so let's build it from the ground up. You've probably seen this before. What we're looking at is a profit loss diagram of a long put at expiration. You bought that put, and given a certain stock price, you're gonna have different profits or losses. Now, let's say instead of buying this put, I want to actually sell a put, sell to open a put. So instead of betting on the stock going down, I'm betting on it going up. What happens is the profit loss diagram flips over the x-axis. So everything that happens to the guy who bought the put, the exact opposite is happening to the guy who sold to open the put. Now, like we discussed in the credit spread video, the biggest problem with this is that your max loss is massive. It's huge. If the stock price plummets super far, you're going to lose a lot of money. And most people just don't have enough money in their Robinhood account to even trade these types of trades, because Robinhood's going to tiptoe in, yoink a bunch of money away as collateral, stuff it in a room somewhere, and hold it there in case the stock price does take a big drop. There's actually money to cover those losses. So most people don't have that much money to enter this kind of trade. So to manage that, they not only sell to open the 26 strike put, but they buy to open one that's a little bit more out of the money as a hedge. And that's going to turn this into a credit spread, where your max loss is much more manageable. And it's just, look at this guy. Isn't he cute? Oh, he's adorable. This is a high probability trade, or can be, and you can make a lot of money doing this. However, we're leaving some money on the table, folks. And what do I mean by that? I'm saying that not only do we want the stock price to be above this point, your break even on expiration day, or what we're saying is it's going to be above that point on expiration day, but we're also saying that we're also covering our butts in case the stock price goes all the way up here to, like, let's say like $50. We have this arrow means it goes on forever, you big dummy. So it goes all the way over there, off the monitor. So we're kind of leaving money on the table because this is a high probability trade. It's covering a bunch of different stock prices in case the stock price does go up super, super far. It's a very high probability trade. But what if we don't think it's going to go all the way up to 50? And now this is a pretty exaggerated number. I don't think you'd ever enter this kind of iron condor I'm about to show you. But let's say we don't think it's going to go all the way up to 50. Let's say we only think it's gonna, it'll be between here and say, $30. We don't think it's gonna go any higher than that. Well, we can actually make more money now, because what we can do, and we can, on top of our put credit spread that we've opened, we can also open a call credit spread, which is gonna look the exact opposite. It's gonna be flipped over the invisible y-axis here. So the call credit spread's gonna be like this guy right there. Now we have an iron condor. That's all it is. It is simply a put credit spread and a call credit spread. What happens is your probability of profit goes down, because now you don't have these areas covered all the way up here. So if the stock price does trade all the way up there, you're gonna start losing money, where before you would still be at your max profit. So probability of profit goes down. But you see how our max profits for both the put credit spread and the call credit spread overlap? Those are going to combine now. Now your max profit's going to be increased. Okay, now it's going to be up here. And in fact, the max profit extends both directions. So it extends over here and it extends over here, which is going to raise your max loss up a little bit. So it's up a little higher. So your max loss is going to be reduced. Your max profit is going to be increased, which is that's both great things, but at the cost of a reduced probability profit. So in summary, an iron condor is simply a credit put spread and a call credit spread, credit call spread, whatever you want to say, combined. So you're betting that it's going to stay within a range instead of just above a certain price on expiration day, by expiration day. And this is these are two credit trades combined. So it's still going to be a credit trade. This is a credit trade combined, so it's still going to be, you're still receiving a credit. You're just going to receive a higher credit initially. And you're going to want to hope that it stays between these two credit spreads. So we're going to build an iron condor the way I do it in real life, which is always starting by looking at the charts. I want to be educated. I want to have a good reason why I'm opening this bad boy up. So what we're looking at here is SPY, the S&P 500 ETF on the 4-hour timeline. And you can see it's trading within this kind of range here with a level of resistance and support, which is perfect for iron condors. We are betting on the stock price trading within a range. So let's say that we decide, hey, this looks pretty good. This looks like it's going to continue staying within this range. I want to put money where my mouth is and make a bet that it's going to continue to stay within this range. Well, what we're going to do is we're going to sell a call credit spread up here, where the strike of the call we sell is going to be about 294. And down here, we're going to open a put credit spread where the strike of the put we sell is going to be about 282. And that will make an iron condor where if the stock price trades within that range and these expire, you will collect the net credit and make money. You can also make profit as it continues to trade within this range, and you don't have to let these credit spreads expire. You can buy to close both of them for a profit, even if they don't expire worthless. You'll still be collecting money as this trades within this range. And you'll see what I'm talking about here in a second. But to build this guy, we're going to pop over to options profit calculator, where I've already started one because I was screwing up. And we're going to put an iron condor together the hard way using our brain bones. Now, not every time you're going to be using your brain bones is hard, but we're going to do it now so you have a full picture of what's going on and you can understand it completely. Later, we're going to use Tastyworks to help us expedite this process so that when we're actually trading, we don't have to sit here and think for an hour trying to put an iron condor together. Don't leave. It's not actually going to be an hour, I promise. So we can either do 4 legs or iron condor on optionsprofitcalculator.com. Link is in the description. We're going to do 4 legs or iron condor. They're the same thing. They have, an iron condor has 4 options contracts in it. So we're going to click iron condor. We're going to trade it under SPY. Now, I've already kind of put it together here. We are going to write a put at 282. That was our top level of resistance. We're going to write a call at 294. That was our bottom level of support. And then we're going to buy a couple options as hedges to complete this iron condor and make it 2 credit spreads. The put we're going to buy initially is going to be 1 strike further out of the money. So if this is a 282 put, 1 strike further out of the money is going to be 281. So let's do that here. Boom. We're selecting the mid price. You could select the... If you're buying, you're going to be selecting the ask usually, but we'll just do mid just to keep things simple. And the call we're going to buy is going to be 1 strike out of the money, which is 295. All right there. I kind of like to trade iron condors and credit spreads where there's not a whole lot of time left, usually because with iron condors, things don't tend to trade sideways forever for long periods of times. And I also want to capitalize on the fact that time decay really kicks into gear within the last 30 days. Theta really ramps up. The value of options contracts decays very quickly. And if you're net short, if it's a credit trade, you're making that money. That theta is going into your pocket. So I like to capitalize on that. So I usually do it within a month or a little bit over a month, but not much more than that. Just me personally. So that's why we're doing September 18th. It's late August right now. So hit calculate and we can see what we're looking at. Oh, I goofed somewhere. Let's find out where I goofed. This is why we normally don't do it the hard way. It's just annoying, but just piece it all together. 282 put... that's my problem. I chose 283. So we're going to do 281. Hit calculate. There we go. Look at that. Isn't that great? 294 at the top. What is that? About 282 at the bottom. Right now we're betting on it staying within that range, but now you can see as each day passes, you're making money and you can buy to close at any point. Or if it continues to trade all the way here and expire worthless, you can collect your net credit. That is so freaking awesome. Isn't that great? You're collecting more money. If I were just to buy one of these or open one of these credit spreads, you would not receive that big of a credit because all of this, for example, if I just open the call credit spread, all of this would be green. Your probability of profit would be higher, but realistically, the stock price is not going to go super far down. And using technical analysis, you can make a reasonable guess that it won't go below 280 in the near future. Now, what if you want to increase this net credit? Make the same bet, like same idea. You don't think it's going to go above here or below here, but you want to increase your risk to increase your net credit and potentially make more money. Well, there's an easy way to do that is by increasing the distance between the strike prices. We don't want to change the ones we wrote because these are the bread and butter of our bet. We don't think it's going to go above 282 and we don't think it's going to go, below 282. We don't think it's going to go above 294. We don't want to change that. We looked at technical indicators to give us a good picture of a good reason to have these 2 strike prices for these written options. Oh, geez. So instead of changing those to increase the distance between our strike prices of our credit spreads, we're just going to change the ones that we bought as hedges. So we're going to move it $1 more further out of the money. So if this is a put 281, we're going to move it down to 280. And if this is a call at 295, we're going to move it up to 296. And what you'll see is going to happen is something very beautiful. Look, now instead of having 70 something dollars as our net credit, we get 136. Isn't that great? So we increased our net credit. We did increase our max loss, our maximum risk. It went from 30 something up to 60, 65. So we're risking more to potentially make more. Now, when you increase these distance between these strike prices, you're going to increase the amount you'll lose if you get assigned. Now you can take around with this. You can see what your net credit and maximum risk, maximum profit are going to be. Your break-evens are not exactly the strikes of the put and call you wrote. In fact, it's going to be the strike price minus the net credit you received. So it's not going to be exactly that. It's just easy when you're just putting it together to think of it that way. It's just a little bit different. So if you want to see your break-evens are right there. It's going to be your strike price of the option you wrote minus the net premium received. Net premium. All right, already. Adam, shut up. Stop talking. Let's go ahead and trade an actual iron condor. All right, we go to SPY. We're going to trade. Let's do the exact one we're doing here. Trade options. Go up to the top. We're doing September 18th. Let's select our calls first. So we're buying, the 296 strike call. Then we're selling the 294 call. And then we're buying the 280 put. And we are selling the 282 put. And look, it says Iron Condor. Look at that. It recognizes our very smart, hard work. Now we go to review. We hit 1. We hit review. What? What is this collateral nonsense? $200? Are you joking? We got $200. What is collateral? What is that nonsense? Well, let me tell you, your boy Adam's got you covered. Collateral is held aside with an Iron Condor because of the risk of assignment. With a credit spread, if it's in the money and you get assigned, your max loss, if you want to see the math, all the math laid out, it's in the credit spread video. And there's a link to the exact part where we talk about assignment, either in the comments or the description. So you can see all the math and how it plays out. With a credit spread, if you get assigned, your max loss or your loss is going to be 100 times the distance between your strike prices. So with the Iron Condor we were looking at, with the call we bought and the call we wrote, one was 296, the other is 294. So the difference between our strike prices, it's 2. So our max loss is going to equal $200. So Robinhood grabs this mofo, holds it aside in case things get in the money and you get assigned, then you're going to lose $200, and that's just going to be it. So it's just holding that money aside so that you can't go trade it elsewhere and then not have money to cover your butt in case you get assigned. So that was the hard way. Options profit calculator is the hard way, but it's a great way to learn how to trade new strategies. What I use to make things easy is Tastyworks. It's a platform. They have a platform that you can use to trade options. That's very helpful. Link is in the description. Everything's all wonky here because I'm hiding my sensitive information, my little private parts. So we're going to go to trading platform. You should definitely, if you're going to trade options, you have to have this, man. It is so handy. We're going to go to trade up here. We're under SPY, go to strategies, go to Iron Condor, and we're doing the normal one, hit go. There we go. Now we're looking at Iron Condor. Over here is the expiration date, which you can change by clicking this guy. So if we want to do the September 18th one, we could do it right there. We could expand the width between these credit spreads. And you can see the credit you're receiving, the probability of profit here. And if you hit review and send, you can see your max loss. So it's really easy to manipulate the trade. You can change where your strikes are altogether. It's just really easy to move around and instantly see what your credit's going to be, probability of profit, and your max loss. So you can actually see what we're talking about earlier, where we got a $12 credit with a 65% probability of profit. But if we delete one of these credit spreads, we get a $5 credit with a higher probability of profit. So see, I wasn't lying to you. And that's because more of the underlying stock prices, potential stock prices, are covered by our credit spread. When we have another credit spread here, it narrows the area where we have our max profit, limits our probability of profit, increases our risk, and increases our credit. So there you go. Yo, quick shout out to CanGrok for using my referral link. I got a Berkshire Hathaway Class B share worth $200. That was dope. If you want free stocks, I don't use my referral link all that much. I actually use my Discord members' referral links. I'm handing out free stocks like it's candy in there, man. Link to our Discord is in the description if you want your opportunity to flaunt your referral link around. I love you guys. Throw a sub down here for me because I'm autistic and this takes forever to get my thoughts organized. Have a wonderful Labor Day weekend. Peace. I love you.